All right, so the next piece of our trading puzzle is money management. This is the second most important thing that you can possibly be focusing on in your trading is money management. The most important thing is mindset. With good money management, even if you lose 50% of your trades, you can profit in your trading strategies. So, how do we determine what good money management is? Well, I never risk more than 3% in one trade. And what that does is it affords me the ability to continue playing in the market. If I risk too much, the next time I go to trade, I can't play with as much money as I could before. So I never want to risk too much. And I'm comfortable with a risking 3%, which is a little bit of aggressive. It's a little bit aggressive. You may prefer to risk only 2%, depending on what your balance is, depending on your risk tolerance. Personally, I'm willing to risk up to 3% per trade. Now, what I do is that I actually enter 2 trades, and both of them risk 1.5%. And with the first trade, I'm going to be taking profit sooner than on the second trade. I'm going to be taking profit with the first trade in such a way that even if I lose on the second trade, I'm not actually losing any money. That's key. That's part of money management. Take your profits while you possibly can and let the rest of the trade continue onwards if that's what the market ends up doing. And if the market doesn't, it's okay. I haven't lost any money. So we're going to use this as an example. This is not a technical analysis. This is simply showing you the position that I'll be taking and how I set my stop loss, meaning if the market works against me, how far am I willing to go before I finally say enough's enough? It's probably a bad trade. And then how far, and then I'll show you how far I would take profit with the first trade and the second trade. So here's a crossing of the exponential moving average. Now, I'm not saying this is where you would go. We would make sure that everything else is in place with the other confirmations. But we're going to grab this tool right here to plot what a trade would look like. This dark area is the room that I'm willing to give the market to breathe. And the tan area is the direction that I'm anticipating that the trade will go. What I do is that I use the average true range of the previous 14 time frames. So in this case here, I'm using a 75-minute chart. The previous 14 bars have an average to them. And that average, I want to be able to utilize as my calculation. Now, I'm looking for the average plus 50%. So that way, if I have 1 or even 2 candles that are working against me in this trend, the chances of me staying in the market are still pretty good. If they're not, and that's okay. I'm going to lose my risk, and that's okay because I'm comfortable with that risk. That's the key. Be comfortable with the risk so that if you lose, you don't get down on yourself. That's part of the mentality. Okay, so we mouse over top of that bar that I'm entering on. We can see that the average true range of the 14 previous candles or bars is 258. So we go to our calculator and we put in 258 and we add 50%. But we're also going to add the spread, which is the distance between the sell and the buy, because we need that room while we're watching the market move around. Now, for specific pairs, they can be different. So you want to find out what it is specifically for the pair that you're working with. And for me, on this particular pair, it's 1.5 pips or 15 ticks. So my stop loss needs to be 273. So I open up my tool and I set it to 273. Then what I do is that I take my take profit and I make sure that it's 2 times that. So whatever my 273 is, I have to go 2 times that. In this case here, it'll be 546. So now my reward to risk ratio is 2 to 1. Now what happens is that when my first trade takes profit, my second trade is going to take its stop loss and jump up so that I know that I will not lose this trade. There's a little bit more to that. We'll get into that later on, but this is our focus right now, is when that first trade takes profit, we make sure we lock that money in so we're not going to lose. Now, if the second trade ends up working against us, we know that we've locked in some profit, even on a bad trade, so to speak. Now, in this case here, the market goes up, we take profit, and then right away the market comes down, and our second trade would probably just break even on that one, and that's okay. That is how you'd position your trade for good money management, because what we're doing is we're allowing that room for the market to go against us, but then making sure that we've got a good projection of a take profit ahead of time. Now, after this occurs, we can actually re-enter the market, possibly re-enter the market later on. And I'm just going to use this as another example. So here, again, this is not technical analysis. I'm simply showing you how you would position a trade. On this candle, or on this bar, we have a average true range of 280. And it's gone up because the size of the bars have also gone up. So with 280, we'll go to our calculator, and we add our 50%, and we add our spread. So it's 435. So we go like this and put 435 there, and then on the top side it would be 870. So as you can see, after our entry, the market did pull back, but because our stop loss allowed for the room of the market to move, we were still able to profit later on. In this case here, probably even further than 2.0 on the second trade. The first trade would have closed, remember, at that take profit 1 level, but my take profit 2 now has a trailing stop that will follow me along, or I can move after every time the market forms a new low. I can move my stop loss to just beyond that, so that if it does end up going down below that new low, I don't lose a lot of money. In fact, I won't lose anything because I will have profited that much. Or I can use my trailing stop, which is set at ATR times 1.5, in order to follow the market as it moves up. And that trailing stop just follows along as it goes up, ready to catch it if it goes down too far. Now in this case here, let's see if this has, so 435, that would have been it, I think. No, actually, the trailing stop would have stopped here, within this pullback right here. We would have lost that second trade. Second trade would have taken profit with a trailing stop in this area here. So that is how we position our trade with good money management. On to the next video.